All right. I've been asked to make a video about the global dollar shortage because a global dollar shortage will lead to a crash in the stock market, the crypto markets, as well as the precious metals and commodities markets. At least that's my thesis here. And hopefully by the end of this, you'll at least understand where I'm coming from and you can decide whether or not you agree with me or disagree. If you disagree, I would love to hear why, because I can't see why I'm wrong here. Um, anyway, let's go on. Before we get into it, there's a bunch of things that, some of you listening to this may know already, some of you may not. Um, so we'll try to go through it as quickly as possible. But if there's something unfamiliar to you, definitely spend some time to do your own research, because I do think this is really important to understand for your own financial security and future. Okay, so here we have a definition of dollar shortage. Basically, all it is the world runs on U.S. dollars, right? The U.S. dollar is the world's reserve currency, and this was established after World War II at the Bretton Woods Agreement because England got messed up in the war, many parts of Europe got messed up in the war. Asia was, just coming up. They weren't the manufacturing powerhouses that we know them for today. So there was no country really situated to take over as a world reserve currency other than the United States. Okay, back then we were gold backed, and then we went off the gold standard. There's a lot of history there that is not that relevant right now. If you're interested, definitely go look it up. So, if the world runs on US dollars, what does that really mean? Well, it also means that a lot of debt in the world is based in US dollars, and um, goods are traded using US dollars, usually through the form of US Treasuries, right? Okay, so there's a bunch of blog articles. If you just, Google dollar shortage, that'll pop up for you, and why this is a big problem for global markets. Okay, a lot of people think that the Fed prints money. The Fed does not print money. Okay, when they do quantitative easing, all it really is the Fed, as the central bank of America, and because of global, world reserve currency status, is the de facto central bank of the entire world. It tells the major banks, hey, you got to go out into the market and buy up US Treasuries. And so the banks go out and buy up Treasuries at the market, they soak them up, and then they flip them over to the Fed, and then the Fed reimburses the banks. Okay? Now, the money that gets, quote unquote, printed is reimbursed to the banks because they spent their own money to go buy these bonds, and then the bonds stay locked up in the Fed's balance sheet. The banks don't have access to these bonds. Nobody has access to these bonds, okay? So that money never makes it back out into the real economy. Okay? So the Fed doesn't print money. That's not where the money comes from. We will get to where the money seems to come from, but it's not good. None of this is good for anybody. Okay? Long story short, when the Fed does quantitative easing, hedge funds take advantage of this. It's almost like it gives them an excuse to short the crap out of the bond market, and that's what we'll see. We'll see graphs later on as we go through this, okay? And when you short something, you get the money right away. Okay, it doesn't matter what you're shorting as long as because you're selling, right? Short selling is selling. So you're borrowing something that doesn't belong to you, you're selling it, you get the money right away, and then you can use that money to do whatever you want. And the hope is that whatever you sold, as you sold short, the hope is that that thing goes down, or if it goes up, it doesn't go up as fast as whatever you bought with the money that you got from short selling. Okay, and that way you can make profit. Right? So even if your shorts are losing you money, As long as you're making more money with the money that you got from shorting, you're profitable. You're net profitable. Okay, that's the game. That's how they balance these things. Okay, so all right, Fed aside, let's move on. Another prerequisite to understand is that we live in a Keynesian debt-based economy. Now that's a fancy way of saying that Keynes was an economist. Generally, he said that for large economies to function well, it needed some government intervention. And I actually disagree with that. But I'm not here to argue about what's right or wrong, what's better or worse. I'm just here to update you on how things actually work. Okay, we can get into this moral debate later. We can get into, financial engineering at some later time. I'm just here to tell you how things actually work, because we don't live in a counterfactual world. Okay, we can't be talking about how things should be when this is how it actually works. So government intervention, I would argue that government intervention makes things worse, right? All the stimulus and things that we've seen, it's a difficult problem, because without some of the stimulus, definitely a lot of people would have suffered. But at the same time, by backstopping the market in the way that it seems to have done, a lot of zombie companies that are eating resources instead of contributing to society, they stay alive. And that's an economic drain on society. Debt-based economy, debt is money. What you think is money sitting in your account or, sitting in your wallet or purse, it's actually just all debt. And that's how money gets created, is when somebody goes to the bank and takes out a loan, whether it's for a house or a car or a business or anything, or, credit card, whatever. When credit is created, when debt is taken out, that's where money comes from. Okay, and so then when you pay down debt, let's say you have a car payment or something like that, and you pay that off, money actually gets destroyed. Okay, that's the main way money gets destroyed. Another way money gets destroyed is if you declare bankruptcy. That you had all this debt, which is money, and now you can't pay it back, and no one can pay it back for you, and you file for bankruptcy, and that gets destroyed. Okay, and so that's part of the problem that we're seeing right now, is that so much of the world seems to be insolvent. We could talk about real estate developers in China. We can talk about, companies in the United States. It doesn't matter. It's looking like we're on the cusp of a lot of money being destroyed very quickly if these bankruptcies start. Okay, especially if it's a domino effect and these dominoes start falling over. All right. World reserve currency, that was World War II. We talked about that. Okay, and so the US dollar is not the only reserve currency. There's other reserve currencies, and there's other currencies that are accepted. You can see it in this graph here. The US dollar is the predominant reserve currency in the world. Okay, there's some trade in euros, there's some trade in other currencies, pound sterling, some Japanese yen, some Deutsche Marks, maybe precious metals can be in here somewhere, maybe cryptocurrency could be in here somewhere, but the point is that the amount is so small that it's insignificant when you compare it to the dollar. Okay, so this is what, 2015, 16-ish, 17? It's over 60%, close to 70% of all global trade is traded through the US dollar or US Treasuries. Okay, Bretton Woods we talked about, that was establishing. Something that you should be familiar with is called the dollar milkshake theory. Okay, now I will post links in the description of this video, and if you follow me on Twitter, I've tweeted it out many times. This is a Santiago AU fund who came up with this dollar milkshake theory, and it kind of describes what I just said. Basically, the entire world runs on US dollars, and they need US dollars, and right now they can't get US dollars. We're going to get into that. Okay, so for example, China, China is growing very rapidly, and they need raw materials to be able to grow. And let's say they need to buy copper. Well, one of the biggest copper producers in the world is Australia. So how does China get copper from Australia? Well, they need to pay in US dollars, right? Australia sells their copper denominated in US dollars. China has to pay for that in US dollars. And so they have to go and get that somehow. And it's the same thing with the real estate developer situation in China right now, where so many real estate developers are looking like they're going to default, right? And they have all this commercial paper that the entire world is exposed to, including US banks, including Tether, that props up, the crypto markets. And so if these companies in China are insolvent and about to declare bankruptcy, that's money destroyed. And if it's backing a significant portion of Tether, that Tether is worthless. I mean, we can talk about how Tether is worthless anyway, but, that's neither here nor there. And it's not just, China and copper and Australia or anything like that. Let's say Asia or Europe, they want to buy oil from Saudi Arabia. Well, that's the petrodollar. And it's the same thing there, right? It gets bought with dollars, and they have to pay dollars, and they charge dollars, through the form of US Treasuries. Okay. There's a bunch of videos that I will link there. I don't agree with everything that the dollar milkshake theory says. For example, Brent Johnson says that everybody should own gold, which I'm neutral on, but Brent specifically thinks that gold and the US dollar will go up at the same time together. And I just don't see that happening for various reasons. Okay. So if we look a little bit more closely, emerging markets or, foreign countries, they've been increasing their exposure to the US dollar over recent years. Turkey is one of the biggest ones. And if you've been keeping up with news coming out of Turkey, it's not looking so good over there right now. Okay, so in 2008, they had, this much exposure, whatever this number is, and then it's doubled since then by the time it hit 2017. Mexico, same thing. Argentina, same thing. Like, remember these names, okay? Mexico, Argentina, Indonesia, Saudi Arabia, Russia, Malaysia, South Africa, Brazil, China, India. Because we're going to see a chart in a little bit about how their currencies have been doing this year. But Turkey's the most well-known one because of what's been happening. I don't even think it's on here, is it? Yeah, so this is a Bloomberg terminal screenshot sent by Santiago Capital, the people that came up with the dollar milkshake theory that I was just talking about. And this is how currencies have been performing relative, this year, total returns year to date. And basically it's being compared to the United States dollar, okay? We've gone up a tiny bit. The Canadians have been doing well, probably because of a lot of the trade that they've been doing. A lot of demand for wood and wood products, which Canada produces a lot of. A lot of demand for silver and gold, which Canada also produces a lot of. Taiwan is known for semiconductors, chips that go into your smartphones, your computers, your laptops, your mobile devices, your cars, computers, like whatever. That's Taiwan. And so because of the global chip shortage, Taiwan has done very well. Because of commodity shortages, Canada has done very well. The United States has basically stayed even because, we are the world reserve currency. We should stay even. In a way, can be, for people into crypto, you can think of this as like a stable coin, kind of. Mexico, Norway, South Africa, like all these countries have not been doing so well. Japan's definitely not happy with us. South Korea is definitely not happy with us. Euro for sure. Also, Britain not too happy about what's going on. But it is what it is, right? Again, these countries were listed here. All right, this is the Turkish lira. If you've been paying attention to Turkey, you know that Turkey has lost about 89%. Its currency has lost about 89% of its buying power since, what is this, 2007. Okay? The currency's been crashing, right? And it took a nosedive this week, actually. Yeah, it dropped 3%, which is a lot, okay? 3% may not sound like a lot to a stock, but like for your whole country's currency to just lose 3% of its buying power, that's a lot. Turkey, earlier last year, they were hoarding gold because they saw local hyperinflation, okay? Again, earlier I said that I thought gold was going to go down, and that's true relative to US dollars. In Turkey, they saw that they were getting hyperinflated, and so they bought gold in a panic. And it's like called mattress gold because, look, 40% of their GDP, 40%, that's a huge amount of their GDP, is being held as gold, and they're hiding it anywhere in their house, under their mattress even. Okay, that's how bad the situation is in Turkey right now. And why is that? Is because they have dollar-denominated debt, and they have goods that they need to buy from abroad, and it's all transacted in the US dollar, and they can't get dollars fast enough. Okay? And by devaluing their own currency, by printing more and more and more Turkish lira to go out and chase these US dollars, it drives the price of each dollar up, right? And so then they have to print more, and that's where you're getting the hyperinflation. So this is real. Now, okay, let's look at some charts. This is the DXY, which is the trade-weighted US dollar index, okay? And let's zoom out a little bit because for the most part, it has been going down at times and it comes up, right? And then this is right around when the pandemic started, right? Let's go back to the daily chart. And let's go back to when the pandemic started. Yeah, this is when the quarantines really went down, right? And what we see here is that in late February, the US dollar dropped a lot. And it's because, places were locking down, there was very little demand for the dollar, but then it shot up again to all-time highs. And ever since then, it's been dropping in value. And part of the reason, this gets complicated, so I don't really want to get into a rabbit hole here, but this is tied to the Treasury market as well, which we'll see in probably the next tab. When the Fed said that they would do quantitative easing, what it meant was that there would be a guaranteed buyer of US Treasuries and that they had virtually unlimited money. And so in order to try to make a ton of money really fast, hedge funds shorted the crap out of the US Treasury market. And bonds and dollars can be thought of as related. Okay, they're not exactly the same. In terms of global markets, sometimes they're treated as being the same. In the repo market, they're treated the same sometimes. Overnight reverse repo market, the $1.4 trillion to $1.6 trillion in overnight reverse repo that we've been seeing so much of. In the overnight swap, they're just treated as, face value. And so when hedge funds short this much and they get money this much, where do they put it? Well, they put it into the market. And so this is potentially a major reason, in my opinion, why the stock market has gone higher and higher and higher, while everything else has not been doing so well. Okay. The important thing to see here recently is, look, the dollar spent about 6 weeks unable to break this overhead level of resistance. Okay, and that was 94.56, I believe. Okay, and recently, and I've been tweeting about this too, it broke above. Probably nothing. Saying that sarcastically, and it broke above, and it broke above, and then when it keeps breaking above and you can't hold it back anymore because demand for the dollar globally is so strong, you get this huge breakout to the upside. Anybody shorting dollars here got squeezed out. That's why we see this big green candle here. Okay. And again here. And today it shot up again. Okay. And when the dollar goes up this much, it becomes a snowball effect that can potentially take down the stock market. Okay, because if you're a hedge fund and you're short treasuries and by proxy you're short the dollar, right? And you're betting the dollar goes down, and because of how much you've been shorting it, you almost force the dollar to go down, right? And you can't do that anymore, and the dollar goes up, and the demand for treasuries goes up. You have to flip from short to long, and then you have to buy those back, and you have to pay that back. It's all debt that you have to pay back, right? And so then what do? Typical short squeeze scenario. You have to sell anything that's not nailed down to the floor to be able to pay back these debts, right? And meanwhile, while this is going on, the entire world needs dollars to keep going. They may not be happy about it, but there's no real other choice. Like, what are you gonna do? Pay in gold? That's awfully inconvenient, right? Because it's heavy, it's hard to ship, you need security. Gold, believe it or not, can be counterfeited because of tungsten. Tungsten has almost an identical molecular weight to gold. So if you just wrap a bar of tungsten around with a thin layer of gold, you would fool a lot of people. Okay, so then that's not that secure, right? It's inconvenient at the very least. Crypto, a lot of people don't really trust crypto. Most places won't accept crypto. And remember El Salvador when they adopted crypto and made it, an official currency of the country and forced their citizens to use it? Guess what happened? As soon as that happened, they got downgraded in their credit rating. Right? And again, I'm not here to get into an argument about crypto. Long term, I'm very bullish on crypto. It's just short term, right now, there seems to be a lot of very shady things going on in crypto. And if you're ignoring this, I think you're delusional. No offense. Okay? Long term, still very bullish on crypto. But right now, because of this dollar shortage, because of demand for US dollars, I don't see crypto staying up this high. And for a lot of other reasons, which we may or may not get into. Okay, so if a rising dollar is bad for stocks, right? Well, why is it bad for stocks? It's because when the pandemic started and local economies were crashing everywhere, well, guess what? The United States has always been seen as a safe haven. We have the most popular stock market in the world. Right? You can joke if you want about how Gary Gensler says we have the most robust, trustworthy, transparent, whatever, okay? The fact of the matter is that the United States stock market is significantly larger than any other stock markets. And in fact, now it's bigger than like the next 11 stock markets combined. Okay, maybe all of them combined. I don't really know, okay? And so all this foreign money comes flooding in to buy US stocks. But now they're short dollars and they need dollars. So what's going to happen? Then the foreign governments, the foreign countries are going to have to sell their stocks to be able to get dollars, right? Or at the very least, get local currency, which they can then use to go and buy dollars, right? That would be foreign banks and investment firms and things like that, right? All right. So UUP is an ETF that tracks the DXY, or it tracks the dollar. The DXY is not tradable. Like, you can't buy DXY. You can buy UUP. And same thing, we see the same pattern here, okay? It follows it almost perfectly. For people into technical analysis, I haven't gone over this in my technical analysis course yet, but other people may see what I'm seeing. Okay, so this dark blue line here is the 50 period moving average. And these white and gray lines is the 180 and 200 period moving average. Okay, and so what happened here? Here, back in July, late July, early August, the 50 period crossed above the 200. Okay, now if you don't believe in TA, you're rolling your eyes and you're saying, well, so what? This is, in TA, this is what's called a golden cross. And this is a very bullish sign. Okay, and if you're short the dollar, if you're short the bond market, this is a very bad sign for you, because that means this is going higher and higher and higher. Okay, so typically when you're under the 200, you're in bear territory, and when you're above the 200, you're in bull territory. Okay, and we can actually see it here. Look, the red line is the 9 period moving average, and it's above the 200. And when it went up, and when it decided to go up, it went up very strongly, with strength. Okay, and we've been up above it ever since, and we've only been going higher. Okay, let's check the weekly chart real quick. Okay, see on the weekly chart, we're still, oh no, wait. Yeah. Weekly chart, today is the first week where we broke above and closed above. That is bullish for the dollar and bearish for the stock market, bearish for crypto. This, like, you have to take this seriously, okay? This is serious. If you're in crypto and you're in the stock market, that is serious. Okay. Treasuries. UST is the 7 to 10 year treasury. Short-term treasuries haven't been doing as well. As you can see here, they've been getting shorted. Lately, they've been getting shorted really hard. And so we're actually in bear territory for the short end of the curve. But on the long end of the curve, we're actually doing really well. All right. It tried to break below the 200, and it did briefly, but it came back up. It tried it again, couldn't get as low, broke back up. Let's see. Somewhere here, I think this. Yeah, this day was the FOMC meeting recently. Oh no, this day. This day. At the FOMC meeting, the Fed Chair Powell said that they would begin tapering quantitative easing later this month. And a lot of people who, don't understand the bond market, don't understand quantitative easing, and don't understand the implications of tapering, and don't know their history about quantitative easing and tapering, they misinterpret this. Okay, whether they do it by accident because they don't know any better, or whether they do it on purpose because they get a kick out of fear-mongering, they get more audience engagement when they do this and say this. Look, they got it wrong, okay? What they misinterpreted was that tapering would be bad for the bond market, because without a guaranteed buyer of bonds, they thought, wrongly, that the bond market would crash because there would be nobody buying this stuff. People would be trying to dump this stuff as quickly as possible because there would be no more guaranteed buyers. Okay, and they thought that the government would default, the Treasury would default, and what is that really? Like, what does that mean when the Treasury defaults on their obligations to bondholders, and what does it mean when the U.S. bond market crashes and goes to zero? It means there's no more America, and that's very unlikely to happen. It's extremely unlikely to happen. So for all those people out there that are still fear-mongering about the bond market and the treasuries and the US dollar and yada, 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 look, it's not going to happen. Because where would people go for a world reserve currency? Europe? Europe's doing terrible right now. Asia? Asia's also doing terrible. Okay? The World Central Bank? Nobody trusts them, right? The World Economic Forum, the International Monetary Foundation, nobody trusts those guys. So, like it or not, and a lot of people don't like it, but the United States is as good as it's going to get for now. Okay? Again, I'm not here to debate what's right or wrong. Morally speaking, this is just the way it is right now. All right. So recently, TLT, this is the 20-plus year Treasury bond ETF. This is 30-year, actually. There's no 20-year, but the average duration is about 18 years. So I don't know. I'm not too familiar with how this all works. There are longer duration ETFs out there that you can check out. We'll look at them very quickly. But they've been shorting the crap out of this. Okay, we can look at Hedgeopia, which we'll pull up in a second, to look at hedge fund positioning, and we'll see that they were really short, and they've been continuing to short it. This, in a way, doesn't make sense. In a way, it does make sense. It doesn't make sense because if the world needs this stuff, why would you continue to short it? It makes sense because maybe you have some sort of narrative to sell. You have to try to convince people. And today was kind of interesting because it seemed like they were stop loss hunting. Okay. Yeah. Right, I've had this line of support drawn for a while, and it broke below. But look, it spent some time bouncing off of it for a while, and then it finally broke below with strength, and it went below again. But then it retested in after hours. I didn't even realize this because I've been making this video, and it's kind of hovering right here. So we'll see where it comes in the coming days, or we'll see where the price goes in the coming days. But I gotta tell you, the day after the FOMC meeting, it sold off hard, right here. It sold off hard right after the FOMC meeting, and it sold off hard the next day, but it recovered some. And then this day, off of like maybe a 1.5% move in the underlying, some call options out there went up by over 200%. You could have tripled your money. This is not a recommendation, okay? I'm just saying that this is how lopsided the market is, okay? I mean, again, do not take anything I say as investment advice. You can always lose all of your money, especially if you have no idea what you're doing. If you don't know how to value, options pricing or anything like that, don't look. It's dangerous. Just be careful. Know what you're doing. Do your own research. Not financial advice. All right. Okay. So why did it drop off? I think it's because President Biden said that he's going to make an announcement about the Fed chair in a few days. Weirdly, it's like after monthly options expiration. Some people think that there's no way that Jerome Powell won't keep his position. I'm one of those people. I think there's a 99% chance that Jerome Powell keeps his position as the chair of the Fed. And other people think that this lady Brainerd, I'm sorry, I don't remember her first name, she may be in line to take over. I think that's unlikely because of some political reasons, but also because it's kind of late in the game to be switching a Fed chair. I think Powell has a good grasp about what's going on, and so far there's been no reason to really fire him. Yes, there's some insider trading scandal, but he sold like index funds at roughly break even compared to pre-pandemic, right? So we had the March crash, and when they recovered to their pre-pandemic levels, he sold. So he missed out on the entire bull run ever since. Okay, now insider trading is bad. I'm not going to argue that, but what's worse? Using insider information to buy options that all go in the money, or make you a ton of money, and you have tens of thousands of percentage gains in 1 year, or buying an index fund and then selling it at break even. There's a gray area there, right? There's many gray areas. So besides that, Powell's done everything that Biden wants. I don't see a reason for him to leave his position. I'm not advocating for him. I'm not a fan of central banking necessarily. Again, we don't live in a counterfactual world. I'm just saying how it is. Okay? All right. This is a 25 plus year US Treasury ETF. Same thing, right? You see the golden cross here. It bounced here. Short sellers tried to sell it down here. It bounced. It's selling off again, but I expect and suspect that it will go back up shortly. If not the end of this week, then by next week, after Biden makes an announcement. If Brainerd makes it in somehow, I don't know. I need to do more research, but I don't think you can escape the global shortage of dollars. Unless she decides to just start printing a ton of helicopter money for everybody in the world, I don't see it happening. I don't see bonds failing to recover from this. I definitely think they're going to recover. GOVZ, that's another ETF of the 25, and again, same pattern, okay, same exact pattern. TYX is it's the yield, okay, it's the 30-year Treasury yield. And there's a couple of interesting things to know about that, okay? So the way Treasuries and yields work is that when yields fall, the face value of bonds go up. And when yields go up, the face value of bonds go down. Okay, so they have this opposite relationship. They're inversely related, right? And the idea here, a lot of people have been talking about raising rates. And to raise rates, you would need to raise interest rates here, the yields. And the bottom line is that the country just can't afford to do that right now. Okay, our employment isn't there. Our, loan growth isn't there. The debt growth isn't there. Because remember, we live in a debt-based society, and to create money, to be able to pay for this stuff, you need to take out more and more debt. That's just how it works. I mean, before I learned any of this stuff, this was a wild concept to me. It seemed crazy. And if you're having that reaction right now, I agree with you. Okay? It seems completely upside down. But this is the way it works. Historically, if you zoom all the way out, the yield always respects this diagonal line that I've drawn here. Okay? And recently, it broke below. And that was a bad sign for the world economy. And especially for the United States stock market right now, because of all the things that I've said so far. When it breaks below, right, because this is the yield, when the yield goes down, the bonds go up. And really interesting and potentially scary things can start happening when the yield goes down and the bonds go up while the dollar goes up, the DXY goes up, which it was doing, while gold is also falling. And right now gold has been going up. I don't agree that that's normal, but it is what it is. Okay, this is silver, my bad. Silver's recently also been going up, but I think this is kind of a fake out. And I'll tell you why. I think people who own a lot of gold, they kind of see the writing on the wall. First of all, some places, some people, some countries, they need to sell their gold to be able to get US dollars because they have these loan obligations that they need to pay off. And if gold is falling, and it's been falling for about a year or more, okay, look at this. Its peak was back here in August of 2020. And it's almost a year and a half later now. Okay, it's been steadily going down ever since. So I think this is kind of a sucker's rally. I mean, maybe I'm wrong. But I think with this, look, it could be another pump and dump, right? They pump it, they make everybody think that inflation is coming, inflation is coming, inflation is coming. And what do you do when inflation is coming? Well, you put money into the stock market, you buy gold, and you buy crypto. Right? Because the idea is that cash is trash, but if there's a global dollar shortage, it's the opposite. Cash is king. And if you believe in this rally, then you're buying this. But if you don't believe it, then, which I don't, you see this as people up here, they have got some pretty heavy bags that they need to sell. And they're looking for suckers to buy this stuff. And that applies to stocks, it applies to index funds, ETFs, gold, silver, crypto, everything. Okay, crypto is probably especially egregious right now, in my opinion, because of how unregulated it is. And we've seen a lot of fraud happen this year already, with exchanges shutting down, the tether fraud, all the stuff going on. And so if you're buying at these levels because you think inflation is coming, I'm here to tell you that the opposite is true. Okay? Deflation is the real thing that everybody should be scared of. And that is coming, right? The quote-unquote inflation that we've seen basically has been because of cost-push inflation, which is a fancy way of saying, it's supply chain disruption. A lot of people are sick of hearing that because of the government, the Fed and the news talking about this all the time. But it's true. Okay? UUP was the ETF that tracks the dollar. Look how much the call options went up today. Okay? I mean, these are some pretty significant gains for just buying future dollars. Like, you're using dollars now to buy dollars in the future, and you're making money off of this. This is... I mean, this is kind of wild. Again, this is not a recommendation or investment advice. Know what you're doing. Do your own research. Okay, especially if things have run up this much and it may be due for a pullback. Okay, you can always get burned on this stuff. I was looking at the economic calendar on, different websites. This just popped out to me. This is Turkey. This is their tourism. And before they were forecasting 40%. The last month they were, it was 59. Look, this is a huge drop. And going back to the global dollar shortage, how do foreign countries get US dollars? It's not like we just give it to them for free. That's not how it works. They have to get it somehow. So tourism is one way. And Turkey is desperate for US dollars, and they're going to have a terrible tourism season, especially because it's headed into the winter, but it's not looking good. So why is deflation coming? This is one of the big reasons. Okay, there's a lot of macroeconomic indicators that are pointing towards deflation. This is one of them. Okay, we've got 111 container ships floating off the coast of California. And it's not just California. All the port cities, all the ports in America have a huge backlog. And it's a complicated situation. There's an article that I can share about how truckers mostly aren't unionized, and the ones that are unionized see what's going on, and they don't understand how any of these truckers are able to make money. So the non-unionized truckers, which make up the vast majority of trucking, they're doing the only logical thing that they can, which is not driving, because they would lose money if they decided to work. And that's crazy. So you can't really blame them for not wanting to work if they're guaranteed to lose money by working, right? And instead of giving them more money or more pay, now there are sanctions, so that if the ports can't get rid of the shipping containers fast enough, they have to pay fines. I think, California has to pay something like $6 million a day or a week or something like that. Some absurd number that would never work. That's a guaranteed way to make sure that the shipping crisis persists, right? That's not the way you fix this problem. It's a huge logistics nightmare. This some tweets by Finance-A-Lot. This is one of the best follows on Twitter, in my opinion. The others being Stephen Van Meter and Colorado Travis. I retweet their stuff very often. So if you follow me on Twitter, I'm the most active on Twitter. You'll see me retweet their stuff all the time. Okay. He talks about the shipping situation here, right? There's 65,000 empty containers sitting on docks. Empty containers. And it's because they have nowhere else to put them. This is the kind of behavior you see in a recession. And looking at the numbers, we are in a second recession already. It's just that the government hasn't officially announced it yet, right? And there's about 1.5 million containers sitting on all those ships. On the 111 ships sitting out there at sea, there's about 1.5 million containers on them. That's where the cost push inflation is coming from, because people who want to buy stuff can't, because it's all floating out there at sea and there's no way to get them. So there's competition for what little goods are left on the shelves. And what we're starting to see now is that many places, their store shelves are either empty or they're filled with garbage that nobody actually wants, just to make it look like the shelves are full. Next time you go shopping, whether it's a Target, a Walmart, or whatever, right? Pay attention. Look around. See what's actually on the shelves. And see if you can get stuff that you want. And it gets a little bit scary, because potentially a lot of department stores ordered winter clothing, and it's still sitting out there at sea, and though temperatures are getting colder and colder, there's a real chance that there may not be enough winter clothing for people to buy, to wear, to get through the winter. This is something real that is happening. All right. Here's another reason why inflation will be transitory, and it's because we have seen 10% inflation but only 1.7% growth, and that's not sustainable. So what happens when things aren't sustainable? What happens if something costs too much money and you don't have enough money to pay for it? You stop spending. You stop buying those things. You cut costs in other places, right? And retail customers like you and me, if you put us all together, we make up about 70% of the entire economy. And what have we seen lately with the earnings calls? Earnings are terrible, and so stocks sell off. Peloton was probably the worst one. It dropped by 45% in one day. And why is that? It's because people don't have the money to pay for luxury items like a Peloton or a subscription to Peloton. And so their sales have suffered. And their subscriptions have suffered. And that's why. Same thing with places that are predominantly based on advertising. Right? So Snapchat, I think, lost a ton of money because Snapchat, I mean, their primary source of revenue is advertising. And you'll see the same thing happen with Facebook and Google. You know, maybe Amazon sells less stuff as well. So again, this is a huge divergence. Truck tonnage is low and headed lower because of the shipping crisis. Meanwhile, the S&P 500 is going to higher and higher highs. And so you have to ask yourself, who's right? I think this is right. The S&P 500 is probably too high. And when reality hits, it can crash very quickly. Just like what we saw with Tesla last week when Elon said he was going to sell stock. It dropped so fast from the mid 1200s to hitting the high 900s. I mean, that was a fast drop. And Elon's not done selling his stock yet, right? And at this point, Tesla makes up a huge portion of the S&P 500. All right, what's next? Right, the US dollar index. Again, Finance a Lot. Shout outs to Finance a Lot. The pattern that he's seeing here, right, compared to the Baltic Dry Index, the railroad traffic, consumer discretionary income, PayPal. That's one thing I forgot to pull up. Consumer discretionary income is at like an all-time low, right? Maybe not all-time, but it's low and headed lower. And what is consumer discretionary income? It's the money that you have left over to pay for stuff that you don't need to survive. So whether this is spent on entertainment or travel, you know, tourism or whatever. People don't have this money because fuel is more expensive, food is more expensive. All these things are more expensive. And so you'd have less money at the end of the day to spend on things that actually, you know, pump up national GDP. Right? So check out these charts from him. They get a little bit complicated, but just know that if the dollar rips higher, it's bad for the stock market, it's bad for gold and silver, and it's bad for crypto. It's bad for literally all the things that most people are buying right now. Okay, this is money velocity. Money velocity is it's how much money is flowing through an economy. Okay, and what you see here is that this is M1. You should look at M2. But it's low, okay? Money velocity basically is just how easily are you able to get dollars, okay? Because you could be employed and maybe you don't make a whole ton of money, but there's a lot of customers, and so you could if you wanted to. And money velocity is low when people aren't spending money. And look at this. We're at 1.115. A money velocity of 1 basically just means that you get paid and that's it. You're not spending it. We're at 1.115, which means we're barely spending any money at all. Okay, that's the entire country. Let's zoom in. Okay, just drops off a cliff as soon as we enter pandemic territory, right? Q2 2020, that's, you know, this is where quarantine hit, right here, Q1. And just drops off a cliff, and it hasn't really gotten better, and it's trending lower. Let's look at year over year. Right now, it got a little bit better, probably because of unemployment benefits and stimulus checks, and you know, jobs coming back. The weather was nice, whatever, and now we're trending down again because all that money ran out. Right? Unemployment benefits ended this quarter, and so people were going to face some sort of fiscal cliff here because jobs haven't really come back, you know, not at the same level. Let's look at loans. Again, when loans get created, money gets created because we live in a debt-based society. As crazy as it is, that's the way it is. Loans have gone down. Let's look at year over year. We're in negative territory. This was before the pandemic. This is now. Now it's improving slightly, but not compared to pre-pandemic. We already weren't getting much pre-pandemic. And that's where money gets created, right? All the stimulus drove it up, got spent down, and then it dropped off. And now we're starting to pick up again, but not fast enough. And loans are hard to get right now because people may not be creditworthy. The standards have tightened up a lot, and also because of quantitative easing, banks are in a tight spot where all the big banks, they have something called the GSIB score, right, which is the globally systematic important bank. And if their score gets too high, they get a penalty. They get penalized. And right now, a lot of them are like on the border of making it into the next bracket where they'll have to pay a bigger penalty, a significantly bigger penalty. And so as a byproduct of that, they can't expand their balance sheet, and so they don't lend. What is this? Loans and leases and bank credit. Same thing. We've been going down year over year. We were in negative territory, and then we broke up above it a little bit, but we're still below pre-pandemic levels. Right? So a lot of money was destroyed here. A lot of debt got destroyed here. Okay? And if bankruptcies start happening, that number goes down more. Okay? This is the unemployment data. Normally, for tapering, the Fed has never in history tapered before unemployment reached normal levels again. And this is the first time that it has. Okay? Unemployment normally hovers in the 200 range, and we're above that by a fairly big amount. 267,000 initial claims per week. Okay, we're trending lower, which is good, but a lot of these might be seasonal jobs, right? Holiday buying season, Black Friday shopping, temporary jobs, maybe warehouse jobs, things like that, right? A year ago, look at where we were a year ago. This is some scary numbers. Okay, we were in the 300s and 400s for a long time, and then we finally broke below 300. We're in the 200s now, but still significantly higher than pre-pandemic. Okay, this is why I said that the Fed would not taper. And they did taper, so I was wrong. But tapering now most likely is a policy mistake, and I think quantitative easing will come back. Again, this video is getting so long. I apologize. If you're still listening, wow. That's all I have to say. Jobs. Lots of jobs opened, but not actually a lot of people taking those jobs, getting hired by those jobs, and working those jobs. Treasury and agency securities. Why did I pull this up? I don't really know. These are all this is quantitative easing basically here. Hourly earnings. This might be interesting. So it looks like we're going up, but you'll see from the labor force participation rate that even though wages have gone up, it doesn't really mean anything because things have gotten more expensive and wages haven't gone up enough to account for inflation. Right? Here, labor force participation. As soon as the pandemic hit, let's zoom in. Look, our jobs numbers, labor force participation rate hasn't even recovered since the 2008 level. The best times we had were 2000s at the dot-com bubble. This is not looking good. This is looking really bad. And look, we're still significantly lower because people are afraid to go back to work. People realize that they have to stay home and take care of the kids. People maybe don't want to work. Maybe some people have made a fortune in crypto or the stock market and they don't feel the need to work anymore. There's lots of reasons. We don't really know all the reasons or the breakdown of it. Year over year, we've improved year over year, probably because people realize that they needed to get jobs. Let's see here. September is when we lost unemployment benefits, if I remember correctly. So, and we're headed lower, is the crazy part, right? We lost unemployment here, and instead of going up, we went down. That's not looking good. All right. We're going to jump back to TLT. I apologize for, this not being as organized as it could have been, but there's a lot to talk about. This is the short interest on TLT. This is where hedge funds shorted the 30-year bond, okay, or the 20 plus, whatever. And look at this. It's been going higher and higher and higher. They've been shorting more and more TLT. And this is from Hedgeopia. Hedgeopia is a website that I visit all the time. If you have the time and you want to read about this stuff, I highly recommend reading their articles. You go to the archives, select, current month, and you can find a whole list of articles. But here, TLT short squeeze. Whoops. TLT shorts get aggressive. Squeeze odds up. There's a chance for TLT to short squeeze because of global dollar shortage, because of everybody needing US dollars through through treasuries to be able to pay for stuff that they need. And hedge funds are still shorting this. Why? Do they know something that I don't? This seems kind of crazy to me, okay? But look how short it was, all bonds, right? And I kind of understand it, right? Quantitative easing, the Fed's buying unlimited, you've got a guaranteed buyer, like, it's free money almost. And everybody hates treasuries because they move so slow. Well, normally, right? Assuming that you're buying shares of it and not call options. Again, not a recommendation. That they shorted 4 standard deviations net short of bonds. This is, the most recent article. I think there's another one coming out soon where we'll see an updated, so they've been covering their shorts here. Look, in November of 2020, a year ago, this was like 4 standard deviations in that short. And if you're familiar with statistics, a bell curve, whatever, 4 standard deviations is a lot. Like 1, 2, 3, 4 is like all the way over here. And if you've been following on Reddit and you know Adabit, and he wrote the everything short. If you're not familiar, go on Reddit, Superstonk, look up the everything short by Adabit, ATOBITT, I think. We know that hedge funds have been shorting the crap out of treasuries. And, funneling that money off to the Cayman Islands and all this other stuff that we won't get into. But this is where a lot of that money has been coming from. Okay, it's not the Fed printing. That's not what happens. It's hedge funds shorting the crap out of the bond market and then putting it into treasury, or putting it into the stock market. Look, this is the March crash. I mean, like, look at this, right? This is the dot-com bubble. This was in 2000. And it took us almost a decade to recover, and that was 2007 when the housing market crashed. Starting in 2008, but the market didn't even crash until 2009, which is what we're seeing now, essentially, like this delay, this lag. And then it took us another few years to recover from that. This is March, and we're up here now. So and here's the unfortunate part, right? Is that I think a lot of wealthy individuals have some pretty heavy bags they want to offload because they know about this, right? And because they know that because of how crazy these last 2 years have been, we've not dealt with a global pandemic in our lifetimes. We've not had to shut down the entire world, essentially, for as long as we did. And after shutting it down and attempting to restart it, we've not had this, situation before. It's all bad. Look, I think they want to offload the bags that they're holding because they know that if it crashes, it has a very real chance of crashing really hard. I don't want to throw out a number or a prediction because I have no idea, right? I'm just a guy on the internet talking trash. But this is real. And what's happening here is like all the people with 401ks and pensions and, IRAs and things like that are in some sort of automatic passive plan. They're just slowly buying up things at all-time highs. And when it crashes, those are the people that are going to get impacted the most, the worst. That's what I think is happening. I mean, this is crazy. Like, come on. And the same thing goes for Bitcoin, right? In the March crash of 2020, Bitcoin went down to as low as $4,000, and now we're at 69. Okay, we're at 59, but you know. And the thing is that I am still of the opinion that Bitcoin died in April. We had a wick-off, topping pattern here. It tricked a lot of people, trapped a lot of people into buying Bitcoin at all-time highs. And then from April to May, it crashed. And then it went back up. But if you're familiar with crypto, there's this thing called the mempool. And the mempool is basically a proxy for the order book. It's a proxy for demand. I'll show you. This is the 1-year mempool in Bitcoin. Okay, and so here, the spikes, we see that there's a lot of demand for Bitcoin. And it peaks in April or May. And that makes sense. It was $65,000 per Bitcoin here. And then there is that news about China banning it, yada, yada, yada. All the excuses that you've heard many, many times before, and then it just drops. And then the mempool is just dead. So then, going back to the chart, where did this price action come from? Look, this was September of 2021, and this was October, and this was now November, right? These spikes came out of nowhere. Look, September right here, relative to this? Are you kidding me? And then at the end of October, look, this is the end of October, where Bitcoin hit 67,000 and then flash crashed to 8,000. I mean, that's scary. If that doesn't sound fraudulent, to you, I don't know what you're thinking. And then now, recently, look, it was 69 a couple of days ago off of this tiny imperceptible spike. The demand is not there. There's no demand for Bitcoin, according to the mempool, right? And so when you start seeing things like politicians saying that they'll accept Bitcoin in lieu of payment, and because they think inflation is coming, which it's not, and celebrities and sports stars saying that they'll take, and esports stars, okay, taking crypto as a form of payment. Consider this. Is it because whales, people who own a lot of crypto, know that if they tried to sell it for fiat currency, for US dollars, because there's a global shortage of US dollars, do they know that if they sell their crypto, that they will crash the market? And they don't want to crash the market. They want to keep it propped up, and they want to sell over time. But because the mempool is dead, they can't. And so these whales, they're giving it away for free and using it as a write-off on their taxes. Could that be happening? I think you have to take that question seriously, because I think that there's a very real possibility that the answer there is yes. Now, Ethereum is a little bit of an anomaly here, okay? The mempool, let's go back to the 1 year. The mempool has gotten stronger and stronger since, this was April, the May crash here, right? So why is Ethereum so much different from Bitcoin? Well, the interesting thing about Ethereum compared to Bitcoin is that you can mint NFTs on Ethereum. And that is a way of laundering money. If you're a criminal, if you have got some dirty money that you need to launder, let's say you have some dirty crypto that you want to launder, right? Well, what is minting an NFT? You burn, right? You burn, meaning destroy, crypto to mint these NFTs. And then on the other end of it, you have this clean NFT that you can sell for a profit. And there's some tricks to kind of get NFTs to, appear to be worth a lot. And then maybe somebody buys it. And then on the other end of it, you get paid in this clean crypto. And you have multiple wallets you can bounce through and all this other stuff. And the SEC has talked about a little bit of this too. Gary Gensler himself has said numerous times in various congressional hearings that crypto is rife with fraud, that stablecoins like Tether are essentially poker chips in a casino, and they're being used to escape anti-money laundering laws and to evade taxes. That's what he says, not me. I can see it, right? I can see it being a possibility. And so when you see all this stuff and you put it all together, and you know that there's a global dollar shortage, you have to ask yourself, is it smart to be YOLOing on, all these shit coins, these altcoins, certain stocks, and all this other stuff? That being said, okay, I am still all in on GameStop. I've got a little bit of my portfolio hedged in other things, but the vast majority, 90+%, 95+% of my portfolio is still in GameStop, because I'm one of those conspiracy theorists that don't think that short's covered. Okay? If I'm wrong, I'm wrong. I don't think I'm wrong, but that's where I am. Okay? Besides GameStop, which, I definitely think GameStop is a company turning the ship around and going places in the future. Besides GameStop, I'm just in this stuff. US Treasuries, I got calls on TLT. I'm looking to buy calls on UUP. But again, it ran up so much that the call options are overpriced. So I'll be watching. Again, not a recommendation. All right. Look, if you're still listening to this, I don't believe you. I've been talking for an hour and 7 minutes. So thank you. Thank you very much. Hopefully that clears up some things for you. Hopefully it makes sense. If things don't make sense, definitely reach out to me on Twitter. I'm at Conway Yen on Twitter. If you don't agree with me, let me know why. Okay. If you want to debate about how things should be, look, I'm there with you. Okay. I probably agree with you about how things should be, but that's not how things are. This is a video about how things are. And that's it. Okay. I appreciate you for listening. The content is for informational and educational purposes only. The information contained herein should not be construed as investment or other advice, nor is it a recommendation or solicitation to purchase or sell any specific security. While it is believed the information presented is reliable at the time of recording, no representation or warranty is made concerning the accuracy of any data provided. The content is also subject to change without notice, especially if short sellers continue to short the crap out of things. The content creators, me, involved, assume no responsibility to update this information. We are not registered as securities broker, dealers, or investment advisors in any jurisdiction. Also, they are not intended to be a complete description of the securities markets or developments referred to in the material. We cannot and do not assess, verify, or guarantee the adequacy, accuracy, or completeness of any information, the suitability or profitability of any particular investment, or the potential value of any investment or informational source. Additionally, we in no way warrant the solvency, financial condition, investment, advisability, or any of the securities mentioned in our presentation. Furthermore, we accept no liability whatsoever for any direct, indirect, or consequential loss arising from any use of our product, representation, or presentation, or other contents. Do your own homework, but there's always the possibility to lose all your money. The last thing, Easter egg, I guess. A lot of people talk about Michael Burry and his bet against the Treasuries. There's two things to know about that. First of all, he has tweeted before, and Roaring Kitty, DFE, Keith Gill himself, has also retweeted that, saying that when 13F filings come out, which the deadline was yesterday, November 15th, 13Fs are full of nonsense. They're full of fake news, and you can't always trust what's written on there, especially because of the time-sensitive nature of investments, right? And so when Michael Burry came out last quarter with huge bets against Tesla and huge bets against US Treasuries, and guess what? Tesla went up. US Treasuries went up. And you can only conclude that he lost a shit ton of money. Well, consider this. Because of how you can essentially lie about your 13F, right? Technically not breaking rules, but also being misleading in your 13F is what I should say. I don't think he's that dumb, right? Like, he knows that you can't short a cult when it comes to Tesla, Now, I like Tesla, but it is a cult. And he knows that a global demand for dollars would lead to a rise in treasuries. Well, he also tweeted that he's annoyed, essentially. Well, how do you get rich off of a small amount of money? Work in financial media, read a 13D, front run those, and then write an article about it. That's what he said. So maybe, just maybe, he put out that 13F to essentially see who would follow him into this trade, knowing that you were going to lose money. So just because Michael Burry is invested in it, and he was invested in GameStop, and he was invested in Bed Bath & Beyond, maybe he was getting back at people like that and leading them into bad investments. Because the important thing here is to do your own research, not listen to other people on social media just because, and to really think independently for yourself, figure this stuff out, and then make investment decisions based on that, instead of just copycatting other people's research and investment decisions. Okay, that's it. Thanks again. I will end it now.